Hello, everyone, and welcome again to Richardson Capital Management's Economic and Investment Review. I'm Mark Steele, and sitting next to me is our investment director, Dan Brown. Today, Dan, why don't we wrap up our fourth quarter and give them kind of a year-end review of our capital markets?
Sure, Mark. It's interesting because the fourth quarter and the full year 2021 were very similar. So stocks were strong in the fourth quarter as they were for the full year, and we saw leadership exhibited by the large cap stocks. So as stocks represented by the S&P 500 did very well for basically the third year in a row. So kind of a really historic strong run year the last 3 years for the S&P 500. Small caps did well, up double digits, and lagging in third and fourth place were international stocks and then emerging market. And then on the fixed income side of the ledger, fixed income had a challenged year. So interest rates rose throughout the course of the year. So kind of a mixed year for performance. Some bonds were in negative territory, some were slightly positive. Those that are interest rate sensitive, like U.S. Treasuries, were probably negative, slightly negative on the year. And we think the same thing is going to happen, next year as we look into 2022. So kind of a challenged outlook for fixed income in general. And the factors that pushed the equity markets higher throughout the course of the year was monetary and fiscal policy stimulus, which I know we'll get to in the next segment. But we think there's still going to be monetary and fiscal policy into next year, just not as strong as it was the past year and a half.
So, Dan, you briefly touched on monetary fiscal policy. Can you expand on that a little bit for us?
Sure. Let's just review monetary policy first. And by that, we're referring to actions from the central bank, so the Federal Reserve here in the United States and other central banks around the world. But monetary policy has been a very favorable tailwind the last year and a half to the financial markets. So just to review what the Fed has done, they've taken interest rates to near zero, and they've been buying about $120 billion worth of bonds every month for the past year or so. And we learned in mid-December that the Fed's going to drastically reduce the amount of their bond purchases. And if they stick to their pace that they indicated, they will wrap up their bond buying program in about March. And then, and only then, will they consider raising the level of Fed funds interest rates, which has been basically at zero for the last year and a half. So we think maybe 2 to 3 interest rate increases from the Federal Reserve is in store for 2022. We don't think that'll kill the bull market. We still think that's a very accommodative stance on monetary policy. And then on the fiscal policy side, we think a lot of the federal spending is primarily over as the COVID situation really does improve. And what that means for the states is the states haven't had to spend much at all for the past year and a half because the federal government has stepped in and provided a lot of the funding. So states are flush with cash. So the first graph we're showing is just the surplus that states are running, and they've been running a surplus now for 2 consecutive years. First time this has happened in many, many decades. And the second graph is basically showing that the federal government has stepped in to provide a lot of that funding. So the states are, again, flush with cash, and with a lot of gubernatorial elections coming in November, we think those governors will spend that cash, and that'll be, again, a tailwind to the financial markets and the economy into 2022.
So, Dan, I mean, in general, 2021 was a pretty decent year. Can you give us your outlook for 2022?
Sure. So our outlook for 2022 is still positive. So for the stock market, we think returns are going to be more modest. Definitely not what we've seen the past year or the past couple years. So the past 3 years, for example, the S&P is up 26% annualized, whereas the historic average for the S&P is in the range of 8 to 10%. So we think returns more in the historical average will be in store for 2022. And why do we think that? Again, we've had a very strong run. Valuations are very strong, historically high, but we think we will get earnings growth in 2022. So we think most of the return is going to be from earnings growth. So if we see an earnings growth of 8 to 10%, we think that returns should be similar. As far as leadership is concerned, again, we talked about the fact that large cap stocks, as represented by the S&P, have been very strong. We wouldn't be surprised if, for example, say small cap stocks take that leadership into 2022, mainly because their valuations are so much more attractive than the large cap stocks. And then on the fixed income side, again, we think it'll be a challenged environment as interest rates should go up over the course of 2022. The economy is strong. That's one reason why rates should go up, and the Federal Reserve will be less accommodative and probably raise interest rates 2 to 3 times into 2022, which will put some pressure on fixed income returns next year.
It's always really good stuff, but we really appreciate all your business. I hope you have a very prosperous 2022, and join us again next year at Richardson Capital Management for continued economic and investment updates.